What was once an inexpensive, straightforward idea has turned into a mess of fees, complexity, and very little transparency. I'm talking about target date funds. And if you have a 401k, there's a very good chance you're invested in one. But are target date funds the right investment for you? That's what I'm going to help you figure out today. Hi, I'm Jared Kinney, wealth advisor with the Noble Group, with over 19 years of experience in the financial industry. So what are target date funds and why are they so popular? Well, target date funds were designed to solve a very real problem. Most investors are not portfolio managers. We chase performance, react to headlines, overweight familiar stocks, or make changes at exactly the wrong time. Target date funds were designed to remove that temptation. They automatically rebalance, gradually reduce risk as you age, and force discipline through market cycles. That's why more than 2/3 of 401k participants own at least one. For many people, the only decision they ever had to make was choosing the year closest to their retirement date. And honestly, that was a feature, not a flaw. The problem is, where did things start to get complicated? It has to do with what's been added under the hood. Years ago, most target date funds were built from a relatively small group of low-cost index funds. Clean, transparent, and easy to understand. Over time, though, that's changed. Many target date funds now hold 24 or more underlying investments. You'll often find separate funds for large cap growth, large cap value, mid cap, small cap, factor-based strategies, international slices, emerging markets, multiple bond strategies, and sometimes funds with names that sound more strategic than descriptive. None of this is inherently wrong, but complexity doesn't automatically equal better outcomes. In many cases, it simply makes it harder for participants to understand where risk is coming from and how costs are layered. Now, another major change that has happened quietly in the background is the shift from mutual funds to collective investment trusts, often called CITs. Today, more than half of all target date assets sit inside CIT structures, and on the surface, this move makes a lot of financial sense. CITs are often cheaper than mutual funds. They don't have the same marketing or regulatory costs as mutual funds, and they've helped bring down expense ratios in many 401k plans. But here's the trade-off: less transparency. CITs are overseen by bank regulators, not the Securities and Exchange Commission that oversees mutual funds. CITs don't provide the same level of public disclosure that mutual funds do. That means it can be harder, and sometimes much harder, to see every layer of fees or fully understand what's inside the portfolio. Again, this doesn't automatically mean that CITs are bad, but it does shift responsibility onto participants as they now need to be more engaged with their investments. One area that is drawing immense attention from advisors is the potential inclusion of private or illiquid investments inside target date funds. Mutual funds are limited in how much illiquid exposure they can hold. CITs don't have those same constraints. That opens the door, at least in theory, for higher fee, less liquid investments like private equity, private credit, or non-traded real estate to find their way into retirement portfolios. Now, what does this mean for you? Well, the concern isn't that these investments are inherently risky or inappropriate. In the right context, they can play a role. The concern is whether they belong inside your 401k, especially if you don't even realize they're there. Target date funds work precisely because investors don't trade them often. That same hands-off behavior is what makes transparency so important. So at a minimum, I'd encourage you to do these 6 things. Review your 401k investment lineup. Look at the target date fund fact sheet. Understand whether it's a mutual fund or a CIT. Ask what the underlying holdings are, ask how fees are layered, and ask whether any private or illiquid assets are included. Next, click here to watch our other video that covers all of the options you have with your 401k once you hit retirement, including one strategy that could save you more than $100,000 in taxes. We'll see you there.